Hello, Comply audience. Thanks for being here this afternoon. My name is Jason Mikula, and I'm a fintech and banking consultant and the publisher of Fintech Business Weekly. I'm excited to host this discussion with leaders from the buy now, pay later, and point of sale financing industry to discuss how they're connecting with consumers and merchants in this exploding space, some of the trends driving adoption, and the potential regulatory and consumer protection risks in this relatively unregulated marketplace. So let's get started by introducing our panelists, and then we'll jump right into it. Joining me today, I have Andrew Ting, who's the General Counsel at West Creek, Chaim Lever, who is the co-CEO of Four, Krista Potter, who's the Assistant General Counsel and Senior Director of Product and Regulatory at Affirm, and Mike Lares, the Director of Compliance Advisory at Affirm. So to get started, I want to sort of level set. The term buy now, pay later has gained increasing popularity recently, but it's actually a catch-all term that refers to a number of different product configurations. So let's start by unpacking this a bit and understand what some of the differences are in the consumer-facing products and also from a regulatory perspective. Krista, if you want to sort of kick us off with that.
Thanks, Jason. So you're right that this buy now, pay later is a catch-all. What does it really mean? Is it a pay in four product? Is it an agreement between a retailer and a consumer? Is it your credit card letting you break up payments in a single purchase? Or is it some other combination of factors such as a fintech plus a bank partner? It can quite frankly be a lot of things. And because it takes on so many different forms, one thing you need to be mindful of is what space are you actually sitting in? And then you can let that guide you from a regulatory perspective. For instance, many actually sit in the lending space. Affirm largely sits in the lending space, for instance, and we have a solid inventory of licenses in which to offer our products. Others are catching up to this model, and we've seen some aggressive regulatory actions from states against those who didn't have proper licenses, whether it's because they didn't realize they were sitting in this lending space, or maybe they otherwise made risk-based decisions not to get licenses at all. Retail installment contracts are another example. From a consumer perspective, this is where you have merchants enter into agreements with consumers versus with the fintech or lending partner. This framework dates back from long, long ago, and there are a handful of states that regulate that model as well. You then have to think if you're going to sell those contracts, because that will then involve an analysis of yet another set of licenses, such as the sales finance licenses. So it's really important to know where you sit in the regulatory framework for your buy now, pay later, so that you can properly assess what you're up against from a regulatory perspective. One last point I want to make on this topic is that I think we can continue to see and expect a somewhat aggressive approach in the industry on a state level. And I really think we can expect to see it gain some traction on the federal level as well.
Thanks. That definitely makes sense. Chaim, did you have some additional context you wanted to provide based on sort of your business model and experience?
Sure, yeah. Thanks for having me, everyone. It's really great to be here. And really just to stand true to what Krista said, I think there's different products here that will fall into, alternate buckets of what is traditionally lending or not. And there will be innovation and continuous innovation on the consumer side, on the retailer side. And you're seeing some of that in Australia with B2B, buy now, pay later, becoming a product, or maybe for some services that traditionally haven't been exposed to a buy now, pay later product, such as medical, veering into non-traditional buy now, pay later, and even that's, we could discuss that for a while, but the typical products being, cosmetics, fashion, and other areas in the traditional buy now, pay later, pay in for kind of group, and that's a really different product to a, let's call it fixed APR, with their firm crew kind of here, the Peloton product or some of the other products that exist. And for the consumer, I think it's really important to understand that and essentially know what they're opting into, and as well from a regulatory standpoint, to make sure that those consumers are being protected in being given the right product for them, and as well a product that can ensure a successful repayment and also kind of journey from a financial standpoint.
Yeah, that absolutely makes sense. And I think with, the pandemic and the rise of e-commerce, which was a trend that was happening anyway, but it's been quite dramatically accelerated, we've also seen a growth in the use of point of sale financing and buy now, pay later. According to insider intelligence, the market could reach 680 billion in transaction volume worldwide by 2025. Given that the pandemic, at least in some parts of the world, is beginning to fade, how do you see that impacting the product category and the industry? And let's start with you, Haim.
Yeah, I think it's a really interesting point. There's probably multiple factors that play into this besides for just the product gaining traction. I think the elimination of travel and some other items. Sorry, got a bit of background noise here. Sorry about that. I think we might want to just make sure you can hear me here. The elimination of travel and some other factors are probably contributing to the e-commerce success here, and that being a major contributor to overall volume of buy now, pay later. But I think from a fundamental level and the consumer standpoint, as consumers become more exposed to these products and enjoy this experience away from the traditional credit card, I expect that will continue over time. Once you see that there's products out there for you that may have just been an e-commerce product that now going into store, into let's call it virtual debit cards and the explorative areas of buy now, pay later, I don't anticipate that to lessen, rather the opposite, which is that consumers are using it more than ever. They're enjoying it, and they enjoyed it in a setting that was available during a pandemic. And I think the tools and our products will catch up to them, moving, traveling, cross, let's call it, cross-border or global e-commerce as well. And a lot of these other areas that are now opening up as possibilities. So from a consumer standpoint and from a business standpoint, the opportunity is really just getting started. And I think that's something that does play into regulatory efforts as well, is because as regulation sees this space growing, the earlier you can address some of these issues, the better it will be, both for the consumer and for the brands that work with products. And it will eliminate a lot of the, let's call it, negative aspects of either of those sides, and ensure that a fair product is given across the board.
Yeah, I mean, just the other day, I was reading a couple of articles about consumers deleveraging, right? Using some of the money, whether it's stimulus checks or other sources of income to pay down debt. And I wonder if you, or if Krista or Mike from a firm have any point of view on how consumers' usage, either of credit cards or of this alternative method of financing, may change going forward as a result of what we've seen unfold over the past 12, 18 months.
Yeah, I'll briefly just touch on that, and I'll pass it to Mike, or if anyone else wants to take it. But I think consumers have had, and especially millennials, have had a very negative reaction to credit. There's a reason with 2008 and some other kind of factors that contribute towards that. But when you use products that are somewhat more beneficial for you, depending on the consumer, there's always going to be consumers that fit that credit card zone, and that's a product that's relevant for them. But if you now have access to cash flow at a relatively low cost and free in a lot of these use cases with the pay in full product, and you're enjoying that and you're responsible with that, why would you essentially turn to an APR product that could put you back into that debt cycle? And I think that's a big shift, right? Some consumers are happy to pay the APR on a product that might be in a zone that they seem fair, or they wouldn't be able to otherwise. And they also enjoy the ability to get that for free. And I'm not sure if Mike or Krista, you're seeing kind of similar thing at a firm, but there are products that a firm will cater to, and at an APR that I think a lot of consumers find like that's a calling for them, and a relevant product as well, away from the credit card.
Yeah, I would echo a lot of what you just said. I think the ease of use of the product also is very appealing to younger audiences. Just not having to get up and get your credit card, for example, just being able to apply online, get an instant decision. And then the fact that a lot of these products offer 0% APR. It's just a more appealing product in that there's no, it's amortized, and you'll be paid off without having to get into a cycle of debt.
Makes sense. Shifting gears a little bit, I want to talk about the distribution of this type of product. Obviously, the initial use case was at point of sale, but as buy now, pay later and point of sale lenders are competing for market share and share of wallet, you're seeing new distribution mechanisms develop. For instance, physical payment cards that can be used at any merchant, regardless of an existing financing partnership. How do these evolving distribution mechanisms impact the compliance and regulatory risk for these types of products? Mike, if you want to get us started.
Yeah, I think as the complexity of the product offering increases, so does the regulatory risk. One of the most obvious ways is different regulatory requirements may become applicable. For example, with a physical card, you may trigger Card Act requirements, or depending on the relationship with the financer and the merchant, there may trigger certain type of licensing. I think marketing risk also increases with the variety of constructs that exist for the buy now, pay later product. Different regulatory requirements govern how a product is marketed. And for a merchant who offers multiple financing options, finding a common denominator is difficult, for one, and it also requires a certain degree of risk acceptance in how you message the product. I think regulatory oversight increases depending on the product construct. For example, a state licensed issued product will open up the creditor or lender to state regulatory exams. However, I think risk can be reduced through automation. Taking the opportunity to implement strong compliance controls at the development of the product will really help down the line. Where can we implement controls such as monitoring or alerts that are automated? It's important to identify automated controls, because as the product or business grows, legal and compliance cannot grow at the same rate. And so finding those automated controls is very critical.
Definitely makes sense. Andrew, I want you to chime in on this next one. I haven't heard from you at all yet. The merchants that accept some sort of buy now, pay later integration benefit from increased sales conversions and higher average order values. That's kind of the value proposition to merchants to offer this service. As buy now, pay later and point of sale lending are moving into other verticals beyond the traditional durable consumer goods to more discretionary big ticket items like vacation rentals, travel, and even rent payments, how do you assess the risk of onboarding these new types of merchants?
Yeah, thanks, Jason. I just want to piggyback on what Mike said about distribution risk. For merchants, it can be risky to offer BNPL or point of sale finance solutions, right? So I absolutely need to understand the risk. Whether it's a home improvement contractor, a furniture salesman, or even a travel agent who's now the face of your financing solution with the customer, you need to make sure that that merchant really understands your product, so you avoid the merchant being confused, which leads to the customer being confused, which leads to regulatory complaints and other bad things for everyone. So how do you manage this risk? So it starts when you're onboarding the merchant with merchant underwriting. So for example, taking a look at public record data, consumer complaints, looking at the merchant's websites, physical advertising materials, making sure it's something that your company would want to partner with. For example, I was not paid to say this, but West Creek is a proud customer of Performline's Kraken solution, and we use that to continuously monitor all of our merchant partners' advertising, as well as to action, remedial action, warnings, et cetera, as needed. Verdata is another company that offers merchant diligence services through public record data and industry data as well. So once you pass through merchant underwriting, however, it's important to train every merchant representative, like every retail store associate, because you're only as good as the guy behind the counter, who's the initial person who's talking about what the product is, disclosing the terms, et cetera. And so after you train the people, then you need to continuously monitor them to make sure that no more consumer complaints are popping up, that there aren't patterns, and that you're kind of, it's tricky in a B2B to C business to actually mediate each of those links. But unfortunately, that is what the buy now, pay later and the point of sale finance industry has to do. And so managing merchant risk is crucial for the customer experience and for our companies in this space. Our customers deserve only the best experience.
That's interesting. It makes sense that as some of these buy now, pay later and point of sale lenders migrate or expand from purely online, where it's a bit easier to control the user experience, make sure any necessary disclosures or opt-ins are captured and they're done in a consistent manner. Moving into a physical retail location, and as you mentioned, with human salespeople, changes the dynamic considerably. Can you just expand a little bit on that piece as far as, in an in-store setting, what are the proper controls or procedures to help make sure that the product is described in an accurate and compliant manner?
Absolutely. So you're only as good as the weakest human link in our business. And training, talking points, scripts, videos, stuff that will stick. Our salespeople go to our merchant networks, and West Creek has a robust network of thousands of merchants across more than 40 states. And every month or so, and they will just make sure that, hey, you guy, Mike, you're new, let me tell you about West Creek. How do you represent the product to the customer? Just to make sure that it's fine. And we just do our best. And we listen very closely to our dealers and our customers, because again, the merchant risk is our risk and the customer's risk.
Reminds me of my very first job working at the Gap, offering credit cards to every single person who came into the store.
Yep.
So definitely understand that. And that's actually a good segue to talk a bit about regulation. We've discussed how there are different product formulations. The regulation varies by what the product category is, whether it's a loan, whether it's not a loan. In Australia, we've seen the buy now, pay later industry adopt a code of conduct in an attempt to self-regulate back on the 1st of March. And that code of conduct pledges that they will safeguard customer interest by making it mandatory for operators to conduct financial checks and ensuring that users of the products don't overextend themselves. Do you think a self-regulatory body, something like FINRA, would work for the industry in the United States? Krista, do you have a point of view or context on that?
Yeah, that's a great question, Jason. I'm aware of the Australian AFIA code of practice that they've implemented, and I think it will be successful in Australia. This is an association that, primarily due to legislative efforts from a few years ago, there was every indication that they were going to crack down on this legislation. It didn't end up happening, but it's self-regulated in the sense that the government seems to be signaling that they're okay to let this group see how they can handle it on their own before there's any other intervention. But it's still a voluntary association of members at the moment anyway. With respect to your question on whether I think a self-regulated body would work in the US, I think it will be more difficult to implement in the US simply from a regulatory perspective, just because as a whole, this space is already more regulated than it is in Australia. For instance, we have a handful of states that already regulate this space, and we have hints that the CFPB may be wanting to take a closer look at the buy now, pay later space also. I think too, the US just unfortunately has had a lot of bad actors in the point of sale lending space, and they still to this day continuously push those limits at times. So the notion that it could be wholly self-regulated would just be concerning from that standpoint alone. We also already have some groups in the US, such as the American FinTech Council, and there are others as well, but they were formed to advocate on behalf of the good actors and they're actually able to make some real impacts in a positive way. And with those associations, there are certain guidelines that those members must adhere to in order to become involved. I think that is more akin to the Australian code, as it's looking at it more from a consumer protection angle, versus with FINRA, that's really coming at it at self-regulation from more of an ethics and fiduciary relationship and fraud perspective. But the point is, from my perspective in the US anyway, this is still already a somewhat self-regulated space. So I don't really see it becoming fully self-regulated here. Whereas other countries may have a better shot at that, at the self-regulation model. But of course, time will tell, and we'll see how that pans out here as well.
Yeah, the U.S. Is always a fragmented regulatory environment with different overlapping state, federal jurisdictions, and even at the federal level, different regulators who may have different agendas. So I definitely appreciate that. I do want to talk a little bit about the reputation of the industry. So relatively low dollar amounts for some of these transactions, use of alternative underwriting, and occasionally lack of reporting to the credit bureaus. Aspects of the buy now, pay later product set can resemble a different, much criticized product, payday loans or short-term small dollar loans. I want to understand a little bit about how your organizations differentiate yourselves from that industry and what you are doing to differentiate the industry as a whole in the eyes of the regulators. Haim, if you can sort of get us started on this one.
Yeah, sure. I think, and a lot of this might touch into the regulatory aspects and why this industry is somewhat self-regulated. As buy now, pay later companies, we're essentially looking to perform in a product that brings consumers a better choice. That's in a wide array of representations, but most of the products are either interest-free or somewhat upfront in terms of the repayment amount. I think, to your specific point of payday loans, you could take a $500 payday loan and pay back a $2,000 sum at the end of the year. That's maybe a little bit more sharky, if you wanted to use a word, or a little bit more aggressive as a tool. Our industry in general is really trying to eliminate a lot of the fear that these consumers, whether millennial consumers, minority consumers that traditionally haven't been empowered to credit, and see a lot of these, let's call it highly leverageable loan receptions that they're getting. We're trying to move away from that more and more and bring them options that are relatively, hopefully relatively affordable for them, but also in line with something that we fundamentally believe in, right? And that means that we're looking to shift away from that debt cycle that we've talked about earlier. We're looking to bring products that are more beneficial. And I think that it's truly a different space to the traditional financial products that have historically either been heavily regulated or kind of plagued the consumer set. And I think that to the point of, do we need regulatory aspects, and will regulation essentially come in through here and affect the outcome of where products will go? I'm in full agreement with Krista, and Americans, the US is its own beast and very different setting to Australia. And it's almost there that the consumers are using it at a level that's so widely adapted that you can't really make a change. But we are seeing that here, and the consumers are adapting to this product because of its friendliness, right? And historically, that hasn't been the case for any other brands. And I think every brand in this space likes to focus on being a friendly brand, helping consumers, to Andrew's point, not divvying down some terrible, sales per individual that's just spewing some information about a product that's not relevant. We try and focus on keeping our information very concise and very clean, and making sure that the consumer does understand that. And there are challenges there when you move into the retail setting and the settings that we will go into as an industry, but I think that everyone kind of has their head in the right place of trying to achieve good by the consumer. And I guess as a final point, if it paints any clarity, I don't think many of the buy now, pay later / financing companies are very profitable by any means, and that's not the goal. And the intention there is in terms of getting there, working towards products that get there. But I think the industry is focused on bringing consumers real value rather than gaining as much as we can from every single transaction.
Definitely makes sense. Andrew, if you want to get a last word in on this topic.
Oh, thank you, everybody, for chiming in. As you can see, the buy now, pay later point of sale finance industry is evolving, both on the business model side, but also on the regulatory side. I have no idea what we'll be talking about hopefully in person in New York City in 1 year at next year's Comply conference, but I'm very much looking forward to saying, hey, Krista, you were absolutely right, or Mike, you were a visionary, and we look forward, hopefully you enjoyed this session, and we look forward to future sessions as well.
All right, and that is going to pretty much wrap it up for us. Time just flew by. I really want to thank all of my panelists, Andrew, Haim, Krista, and Mike for providing your expertise and input on the evolving buy now, pay later and point of sale financing space. And of course, thank Performline for putting together the Comply conference. Thank you, everybody.
Thank you.